Let's talk about the net present value and the other investment criteria. We have learned about pricing, stock pricing, annuity pricing, the pricing of different investment tours. But how do we determine whether we should accept or reject a project? So what kind of criteria we can make that decision? To make the investment decision, we need to ask ourselves the following questions when evaluating capital budgeting and decision rules. Does the decision rule adjust for the time value of money? Some does, some don't. Does the decision rule adjust for risk? Does the decision rule provide information on whether we are creating value for the firm? We have multiple decision rules. Each one of them has advantages and disadvantages. So let's take a look at them one by one. The first one is NPV, net present value. We have learned what the present value is. Simply speaking, present value of the multiple cash flows is to calculate the discounted present value of each cash flow, then you sum them up. The net present value is a difference between the market value of a project and its cost. The market value of a project is the present value of its future cash flows, and its cost is the present value of its initial and subsequent investment cost present value. How much value is created from undertaking an investment? That is a question the calculation of NPV is thinking about. The first step is to estimate expected future cash flows. So you want to know what future cash flows could look like. We don't really know how they look like because future hasn't happened yet. But we can expect that if a project is being conducted properly, at normal circumstances, what the future cash flows should look like. And the second step is to estimate the required return for the project at its normal risk level. The third step is to find the present value of these cash flows and subtract the initial investment, and also the present value of the subsequent investment costs. If you still remember the timeline model, think about this. For example, we have 4 years. At year 0, we have an arrow toward below, which indicates investment cost, and it is a cash outflow. So we spend money to do the investment so that we can initiate this project, and hopefully the project can bring us cash inflow in year 1, 2, 3, and 4. Okay, and the NPV calculation is simply the present value of the subsequent cash flows. In this example, T will be 4. Okay, for the 4 cash flows, C1, C2, C3, and C4, we discount them by the corresponding 1 plus r to the power of 1, 2, 3, or 4. Okay, and the sum of them will be the value of this project. But the word net in the word NPV indicates that we need to subtract the initial investment of I from this value of project. And this is the NPV calculation formula. If the NPV is positive, the rule says that we should accept the project. This is a very basic start of multiple rules, but I can give you a hint that this is NPV is also the fundamental and most reliable rule for determining the acceptance of a project or not. This example, you're reviewing a new project and have estimated the following cash flows. In year 0, 1, 2, 3, you have different cash flows. Note that in the first year, no, at the beginning of the first year, or currently at year 0, your cash flow is negative. It's a negative 165,000. Why is the cash flow negative? Because you are making investments, your money is out of your pocket. And in year 1, 2, and 3, your cash flows are positive. I'm sorry, did I say positive? I was trying to say that the cash flow was negative at year 0 because this is a cash outflow. From year 1, 2, and 3, cash flows are positive because the project starts to bring in some cash for you. Okay, and also the net income from the income statement is also positive. But we don't really use them in the NPV calculation. We only use the cash flow. You're also given a piece of information which is not really used in this NPV calculation. That is, the average book value is 72,000. We will use this information in the future. We assume that your required return of assets of this risk level is 12%. How do we give an assumption of the same risk levels required return of assets? It's based on your experience. So it's not very accurate. If you make it 11 or you make it 13, it will be arguable. So it's arguably vague because it's really hard ex ante before everything happens. Currently, you really don't know what the risk level of this project that hasn't been conducted is. So therefore, it is really hard for you to find some other project that can be comparable to this project in terms of the risk level. So you can only use your professional experience to guess, okay, or evaluate whether the market required return for this kind of risk levels assets is like 12%. But hey, we just assume this is 12%. And given that the required return is 12% and the 4 cash flows, how do we calculate the NPV? The NPV is simply the minus I, well, this is a cash outflow, plus the first cash flow divided by 1 plus R, 1 plus 12%, plus the second cash flow divided by 1 plus R to the power of 2, plus the third cash flow divided by 1 plus R to the power of 3, and we get an NPV of 12,000 and a little bit more. We can also use the financial calculator to calculate the NPV. So do we accept or reject this project? Yes, we accept this project. The reason is that the final calculation of NPV reveals that the NPV, given the expected cash flows and the interest rate required return, is positive. Let's take a look at the second one. Payback period. Payback period. So payback period is simpler than NPV calculation. It basically says how long does it take to get the initial cost back in a nominal sense. In a nominal sense, meaning that you don't really consider the time value of money in the calculation. You only compute, you estimate the cash flows and subtract the future cash flow from the initial cost until the initial investment has been recovered. Okay. The decision jury is that you accept this project if the payback period is less than some preset limits. So how do we understand this? Still, think about this example. Payback period basically say, hey, you're spending $165,000 as investment now, and you expect to get these three numbers, three cash inflows in the future. So at what year? At year 1, did I get all of will I get all of the money back? No, because your investment is higher than this number. $165,000 is clearly greater than $63,000. can I get all of the money back in year 2? Not really, because the sum of the two cash flows here, 63,000 plus 70,000 is kind of like 133,000 and a little bit more, which is still smaller than the initial investment. That means at least we need to get all of the money investment back at year 3. So this is a calculation process. So assume that we will accept this project if it pays back within 2 years. Okay? Then in the first year, we have spent $165,000 in year 0. Subtracting the first year's expected cash inflow, we still have 101,880 still to recover. And the next year, at the end of the second year, we expect to receive 70,800. But it's still not enough to cover the remaining balance. We still have 31,080 to be recovered. In year 3, finally, because the cash inflow is expected to be 91,000, which is higher than 31,000 remaining balance, so we can get all of the investment recovered in year 3. But do we accept or reject this project? No, we reject this project. Why is that? Because we only accept this project if it pays back within 2 years. Okay. Here, we find that until the 3rd year, we cannot recover all of the investment. We can only recover all the investment at least from the 3rd year. That's why we reject this project based on this decision rule, payback period. Well, the payback periods have some advantages and disadvantages. The first advantage is that it's very easy to understand. Okay. And they adjust for uncertainty of later cash flows. Thinking about a project that will generate cash flows for 20 years, which is pretty normal. For example, if you have infrastructure project like highway, okay, this project upon being finished is gonna serve for maybe 50 years or 80 years. But how can you really expect accurately the cash flows in many years? Remember that all of the cash flows here, except the initial investment, they're all expected value, because we haven't received this cash flow because the project hasn't been conducted yet. That means it hasn't been started yet. So how do we know the future cash flow? We can only calculate or estimate maybe the cash flow in 1 year or in 2 years based on the current parameters and the observations. For example, how many customers and how many people and their purchasing power, these people living in this neighborhood of this store, this restaurant, or when you're building a highway, you want to calculate the population and the automobile ownership of the cities that this highway connects. Okay, but you can only use these numbers for a couple of years because it's really hard to predict what the numbers will be like in 10 years or 20 years. If you want to use the NPV or the other criteria that will consider all of the cash flows in the future, you will have an uncertainty of later cash flows because these estimates could be very, very inaccurate. But payback period, since it only uses the information of the most recent cash inflows, so it adjusts for the uncertainty of later cash flows. This payback period has, I wouldn't say it's an advantage, but it's just a feature that is biased toward liquidity. I still remember, I hope you still remember that liquidity means the easiness of selling or buying an asset on the market, on a market. And if the transaction volume is really high and you find it's pretty easy to find a potential buyer and seller, then we say this asset has high liquidity or is very liquid. Otherwise, it's illiquid or has low liquidity. Since it only considers the payback period criteria, only considers the early cash flows of the project, it favors projects that free up cash for other uses more quickly. Because why do you want to know for how many years you can recover all of the investment? Because you want to recover the cash, in nominal sense, and reuse the cash for other reinvestment. So therefore, this payback period criteria favors the projects with high liquidity. Okay, this can be a good thing for businesses that care about liquidity. If you don't really care about liquidity, well, generally, most businesses, they care about liquidity, because if you have a lot of assets but they are illiquid, then you're facing a problem of the capital chain, and you just find that you are currently in shortage of cash, and you're unable to pay some debt. Then you may go bankrupt even though you have a large amount of assets. The disadvantages of payback period is also very clear. First, it ignores the time value of money. Second, the cutoff period, like 2 years in the previous sample, is very arbitrary. Okay, you reject this project because you want the project to recover all of the investment within 2 years. If you change the criteria a little bit, you would like the project to recover all of the investment within 4 years, then you would like to accept this project. So the decision could be very arbitrary because your cutoff period, your criteria is arbitrary. It also ignores cash flows beyond the cutoff date. For example, if you have a project that doesn't really recover all of the investment in the short run, for example, your cutoff period is 3 years, and you find that it can only recover all of the initial investment within 4 years, then you tend to reject this project. But you totally ignore the cash flows in the 5th, 6th, and future years that could be really high. A lot of high risk, high return, especially the R&D, research and development, and high-tech projects, they take many years to establish monopoly, oligopoly, or network economy of scale to have a large impact in the market. And when they do have an important position in the economy, these high-tech firms could generate huge cash inflows. But since the technological projects are usually it takes very long time for them to recover the initial investment and quickly make huge profit. These projects will be very likely to be filtered out, will be rejected based on the payback period criteria, even though their NPV could be pretty high. To correct for the disadvantage of payback period that ignores the time value of money, there is another discounted payback period that corrected this problem. So this method computes the present value of each cash flow and then determine how long it takes to pay back on a discounted basis. And it compares to a specific required period, which is a preset limit. The decision rule is similar. You accept the project if it pays back on a discounted basis within the specified time, okay, like 2 years. Still, we consider this example. We are reviewing a new project, and we have the cash flows, we have the initial investment. Only the 4 cash flows will be used in this, and also the required return will be used in this calculation of discounted payback period. In the payback period, simple payback period calculation, we only use the 4 cash flow information. Okay. Here, assume that we will accept the project if it pays back on a discounted basis in 2 years. Compute the present value for each cash flow and determine the payback period using discounted cash flows. At the end of the first year, our initial investment is $165,000. And what is the present value of the first cash inflow? It's 63,000 divided by 1 plus r to the power of 1, because it's at the end of the first year. So you subtract the present value of the first cash inflow from the initial investment, you find that you still have 108,000 and a little bit more to be recovered. Then, at the end of the second year, you use the remaining balance to minus the present value of the second cash flow, the $70,800 divided by 1 plus r to the power of 2. Okay, and you still have the balance of present value, 52,200 to recover. And at the end of the year 3, you finally can recover all of the present value of the initial investment, because at the end of the third year, you have a large cash inflow of 91. You expect a large cash inflow of 91,000. And subtracting its present value from the remaining balance, you find that you are earning additionally $12,000 present value. Okay, so the project will pay back in year 3. So do we accept or reject this project? No, we reject this project because we assume the criteria is that it pays back on a discounted basis in 2 years, but here it only pays back in year 3. Advantages will be almost similar to the simple payback period criteria, except that the one advantage of discounted payback period includes time value of money. Other disadvantages, for example, the arbitrary cutoff period, ignoring cash flows beyond the cutoff point, these disadvantages are exactly the same as those of the simple payback period. The fourth one is AAR, okay, average accounting return. Average accounting return. Okay. There are some different definitions for average, well, actually many different definitions for average accounting return. The one we use in our normally used textbook is average net income divided by average book value. Note that the average book value depends on how the asset is depreciated. And we also need to have a target cutoff rate. If the AAR that we calculate is greater than the preset cutoff rate, we accept the project and reject if it's lower. Still, we look at this example and we compute AAR. We assume an average accounting return of 25. Okay. I think there is a typo here. But anyway, the average net income will be the sum of these net incomes divided by 3. It's going to be the average net income of 15,000. Okay, and AAR will be this average net income divided by the average book value, which will give you 21.3%. And this AAR is actually lower than the required return of 25, so we reject this project. This is a typo here, I'm really sorry. So let me correct it. So do we accept or reject this project? No, we reject this project. Advantages and disadvantages of AAR. The advantage is that it's very easy to calculate. It's very easy. It's even easier than the payback period. And the needed information is usually available because for any firm, every year you always have net income. If you have the net income and book value, you can simply calculate the rates. The disadvantage is that it's not really a true rate of return. And also the time value of money is ignored in this calculation process. It uses arbitrary benchmark cutoff rate, for example, 25%. Okay, you probably say, hey, just look around the market and find the projects with a similar risk. The average return of these projects with similar return risk is about like 25%. Again, how do you decide the risk level for a project that you haven't conducted, you haven't started? You can't. So you can only guess. You can guess it's 25. You can also guess it's 20. If you guess the market average return is 20, then you should accept this project. And you rejected this project because your preset rate is 25%, and you think the calculated AAR is lower than that. Okay. When the preset cutoff rate changes, your decision may change. So the decision is also arguably arbitrary. Okay. It's also based on the net income and book values, not cash flows and market values, because the assets in your book, that means financial statements, may not be really the market value. For example, you purchased some computers years ago, or though you spent a lot of money to purchase them 10 years ago, and in your accounting books, you still record these computers' values there, their purchasing price, but actually in the market, because far faster computers have been offered. So your computer's market values can be pretty low, but it's not really reflected in your calculation. IRR, okay, internal rate of return. Remember that first we talked about NPV because NPV is the most important one. Then we talk about some payback periods. Okay. Then we are talking about the returns. First, we talk about very simple calculation of the AAR. Then we are talking about a more important rate called IRR. It's more difficult to calculate, but it's more meaningful. It's internal rate of return. It's a little bit similar to, it's actually very similar to the year to maturity, the concept of year to maturity in the bond pricing calculation. So this is the most important alternative of NPV. It's often used in practice and is intuitively appealing. And it's based entirely on the estimated cash flows and is independent of interest rates found elsewhere. In the calculation of NPV, discounted payback period, and also the AAR, you all need to find a interest rate that is of the other projects on the market with a similar risk level. Calculating IRR doesn't need an outside interest rate, but to make the comparison, it may need to or may need to compare it with the other interest rate, but the calculation is independent of the interest rate found elsewhere. The definition of IRR is that it's a return that makes NPV 0. Okay, so NPV is this formula. It's this formula, and you just need to find the R to make NPV 0. So you want to solve out the equation when NPV is 0. It is very similar to the calculation of yield to maturity. Okay, so you have two ways to calculate them. The first is using a financial calculator. The second is using a try and error approach. You accept a project if the IRR is greater than the required return Y. You don't need outside interest rate, but you need to have a required return. For example, even the market interest rate is 20%. I can only require 18% because my money is borrowed. I borrowed from somewhere, and some bank offers a 15% interest. So I borrowed this money at a rate of 15%. So I only need my return of any project to be higher than 15%. Then I'm happy because I'm making money. When IRR is getting higher, that is when R is getting higher in this formula, we know that NPV is getting lower, right? Is getting lower. Okay. If IRR is greater than the required return, that means the NPV calculated using IRR is lower than the NPV calculated using the required return, right? Right? Since the IRR is defined as a rate when NPV is 0, that means if IRR is greater than the required return, then the NPV calculated using the required return should be greater than 0. It should be positive, right? So this decision rule is almost, not entirely because I'm going to explain that later, is almost the same as the NPV rule. Because the NPV rule is saying if the NPV is positive when you calculate the present value of the initial investment and the future cash flows using your market required return, or your required return is positive, then we accept this project. But here it says when IRR is greater than the required return, which indicates that the present value, net present value using required return is positive, then we accept this project. Well, if you don't have a financial calculator, then this becomes a try and error progress. Okay, you can calculate the IRR of the previous example, and you will find the IRR is 16%, which is higher than the 12% required return. So, do we accept or reject this project? Yes, we accept this project. Okay. So normally when discount rate is getting higher, the NPV is getting lower. Why do I say normally? Because here we actually have an assumption. Take a look at the previous slide. Here we assume that C1, C2, and CT, all of them are positive. They may be negative. If the project in some years gets you lose money, it's pretty common that you have a project and that project doesn't make money in some years. Then C will be negative. If it's negative, you want R to be lower. You want R to be higher, because when R is higher, the item of C will be lower, and the minus of that will be higher. So your NPV will be higher. So here, the monotonically decreasing line, downward sloping line, has an embedded assumption. It's an intrinsic assumption that all of the future cash flows are non-negative, which is not realistic. There are some advantages of using IRR over the other criteria. First, knowing a return is intuitively appealing, and it's pretty straightforward because usually you wanna just ask people, hey, what is the profitability? And when people are talking about profitability, people are talking about return. Okay, it is a very simple way to communicate the value of a project to someone who doesn't really know the estimation details. If you tell them the NPV and other things, for example, if is NPV 1 million, deposit 1 million, is it a very good project? Well, based on our rule, yes. But people may ask you, like, how did you calculate the whole process? Like, how did you get the 1 million NPV? What is your assumption of the market interest rate? If the market interest rate is actually higher, is your NPV negative? Like, they ask a bunch of questions. Here is just to say, hey, based on the expected cash flow, we just calculate it and find that the IRR is 15%. That's it. So it's embedded year to maturity. It's embedded. It's a calculated implied project's implied return. And if the IRR is high enough, you may not need to estimate the required return, which is often a difficult task. Estimating a required return needs you to find comparable the projects with comparable risk level, which is pretty hard and usually sometimes like impossible. Okay, because like I said multiple times, it's impossible for you to estimate the risk level of the current project you're thinking about before it starts. But if you know that the IRR is pretty high, like the IRR is 40%, then you don't even need to think about the required return. 40% is just high enough. Even 30% is like higher than 99% of the investment targets, investment tours around the world anywhere. So if the IRR is high enough, you don't need to worry about the required return and the other things to explain to your boss who's making the decision, for example. NPV IRR. There are also some disadvantages of IRR. That is, NPV and IRR generally give us the same decision, but sometimes they infer different decisions. There were two exceptions. The first one is non-conventional cash flows. Sometimes the cash flow signs change more than once, and there may be more than one IRR solution. For example, we assume that from this downward sloping figure, we assume that when discount rate is going up, the NPV is going down, so this curve will intersect with the x-axis, the horizontal axis, at some point to make NPV 0. And this intersection point is the value of IRR. But when non-conventional cash flows can be sometimes positive, sometimes negative, then eventually you probably will have a relationship between discounted rate and the NPV like this. Okay, so you will have 2 IRRs, or even more, maybe 3, maybe 4. And this is a target rate of return. So, do you accept or reject this project? Like, which IRR should you use? This becomes a problem. For example, take a look at this non-conventional cash flows. Suppose the investment will cost 90,000. So the initial investment is negative. This is a cash outflow. So it's a negative $90,000 at year 0 initially, and we generate the following cash flow. So year one, you have $132,000 cash inflow. So one is positive 132,000. Year two is 100,000, and year three, your project loses money. You expect that in year three, I don't know how you can expect this, but the calculation is negative. It's a minus 150,000. 150,000. Question: how do we calculate the IRR of this? If you solve out the equation, the NPV equation, you find that there were two IRRs that can make NPV 0. The first IRR is 10%. The second is 42%. The criteria, the required return is 15%. So one IRR is smaller than 15% and the other is greater than 15%. Should we accept or reject this project? This is a question. Okay, the NPV profile will look like this. And the first intersection point is 10% and the second is 42%. Here, if you have this problem, remember that if you have multiple IRRs, you always calculate the NPV. Okay, the NPV is positive at a required rate of 15%, like here. Here the NPV is positive, or here the NPV is positive. Then you should accept this project. If you use a financial calculator, you would get a IRR of 10%, which would tell you to reject. That is a wrong decision. So you need to recognize that there are non-conventional cash flows and look at the NPV profile. The second exception or disadvantage, and also the disadvantage of IRR, is that when two projects or multiple projects are mutually exclusive, the conflict may emerge. When the project has higher NPV but pays back more slowly, then the lower discount rates, it may have a lower IRR. Okay, for mutually exclusive projects. So what's the definition for mutually exclusive projects? The independent projects mean that the cash flows of one project are unaffected by the acceptance of another. But mutually exclusive means that the acceptance of one project precludes accepting the other. You can only accept one but not the other. And this is the mutually exclusive projects here is also related with the reinvestment rate assumption. IRR, like I said, IRR calculation is similar to the calculation of year to maturity. So it assumes reinvestment rates at IRR. It is an implied average yearly return for every period during the project's existence. So every year it assumes that the rate is IRR. But NPV is different. NPV assumes a reinvestment at the firm's weighted average cost of capital, or its opportunity cost of capital. And its opportunity cost of capital is determined by the market interest rate, which is not the IRR. And NPV should be used to choose between mutually exclusive projects if you find that IRR criteria cannot reach conclusion, the consistent conclusion. Take an example. Okay, this is explain. This slide is to explain the mutually exclusive projects. It's like you can only choose to attend graduate school at either Harvard or Stanford, but not both. Okay. Think about this mutually exclusive projects. These two projects. For the first project, you find that the NPV is 64 and IRR is 19%. For the second project, is 22%, but the NPV is
$60, $60 or $1 million. So if you just have two mutually exclusive projects that you cannot really choose both, if you can choose both, what do? You accept both projects because both NPVs are positive. And both IRRs are higher than the required return of maybe 10% or maybe 15% because they are really high, 19% and 22%. You should accept both. But if you can only choose one from the two, which one do you choose? Based on the criteria of IRR, you should choose project B, but based on the project, the criteria of NPV, you should choose project A. Here, I'm just telling you that you always use NPV. Okay, you choose a project with higher NPV because intuitively it gives you more money. NPV is final amount of value that you, positive value, is the remaining value you can get from the investment. Okay, this is the profit you have. Since the project A's NPV is higher than project B's NPV, you got higher profit, so you should choose A's NPV. So NPV directly measures the increasing value to the firm. Whenever there is conflict between NPV and another decision rule, you always use NPV. IRR is unreliable in the following situations. Two, the first is non-conventional cash flows. The second is mutually exclusive projects. Now we take a look at the modified version of IRR. Well, in the previous IRR, we calculate the IRR. We use just we just have a 1R in the NPV calculation formula, so we just calculate 1R. The modified IRR calculates the net present value of all cash outflows using the borrowing rate. Why is that? Because this is your investment. And where did you get the investment money? Usually from the banks. You borrow the money, so you use the borrowing rate. And you have you calculate the net future value of all cash inflows using the investing rate. Okay, you find the rate of return that equates these values. The last one, profitability index. It is defined as present value of future cash flows divided by initial investment. Okay. It measures the benefits per unit cost based on the time value of money. So basically, it is you calculate the present value of future cash flows. You have calculated that for the calculation of NPV. Then you divide it by the initial investment rather than minus the initial investment. If you minus the initial investment, this is the calculation of NPV. If you divide it, you will get a ratio, and this ratio is called profitability index. And this index of 1.1 implies that for every $1 of investment, you create an additional 10 cents in value. This measure can be very useful in situations in which we have limited capital. The advantage is that it's very similar to, very related to NPV, generally leading to identical decisions, and it's very easy to understand and communicate, and may be useful when available investment funds are limited. The disadvantage is that it may lead to incorrect decisions in companies in comparisons of mutually exclusive investments. This is to say that if you have two projects, one project will give you a high profitability index. Say, if you input $1, it gives you, more profit ratio. But the NPV can be lower because when you really invest for one project, it only allows you maybe to invest like 10,000, and the other, or with a lower profitability, it allows you to invest in a larger amount of money and eventually get a larger amount of NPV. Okay. The summary is that you should consider several investment criteria when making decisions, because firms, when you are making investment decisions, you are facing different limitations, restrictions, and also you have different needs and demands. For example, although we say that IRR, modified IRR, and profitability index, they are similar to NPV, but if you have conflict in using different criteria to evaluate the projects, you always use NPV, but they do not consider the liquidity. Okay, when you are thinking about when to recover the investment and you want to reinvest it into some other projects, and you care about the liquidity of your company's assets, then you probably also want to consider the payback period and discounted payback period. Generally speaking, we firstly use NPV and IRR. They're most commonly used primary investment criteria, and payback period is commonly used as secondary investment criteria. And we learned NPV, IRR, and profitability index. These three, they are closely related. And also we have payback period and discounted payback period. These two are closely related. And finally, we have a accounting criterion. Okay, the previous one is DCF, discounted cash flow criteria, and the payback criteria. And at the end, we have the AAR, accounting criteria. Then this is the end of this lecture, and this is a quick quiz and comprehensive problem that the TA will lead you through in the tutorial. Okay, see you in next lecture.